Today, folks, there's no doubt about it that most of the Canadian markets up to this point have been just directly impacted by kind of this higher interest rated environment. Whether we head into a recession, it looks like Canada's already in a mild one. But I want to break down the stocks this year as we kind of head into the final quarter that have absolutely gone parabolic. Not really sure too as much why as we look at some of the valuations on them. And then kind of as somebody that is always thinking toward the retirement side of things, I want to talk about some of these dividend ETFs and why I think they are probably the most opportune thing you can pretty much buy at this point just from a valuation and the stocks that kind of sit at the upper weightings, considering now they're all over 5% yields, which is nuts. Two of them are monthly. We'll talk about some of the US ones. And of course, these ETFs are BDY, XEI, and SCHD. I've been seeing people crap on them a little bit lately, but honestly, when I look at the top weighted holdings between all of these, I think there's much better value set up for the future than most of the stocks we're about to look at today. But if we take a look at the broad view of the Canadian markets first and foremost here, what I find most intriguing is the farther you zoom out, the worse it begins to look. And it really shows you how like lucky you would have had to been to actually win at the Canadian market over the last, year. If we take a look at the 30-day, because oil was doing pretty well, leading up to the last little bit here. I mean, you can see some pretty good performance in some of these, like Enbridge was still green. CNR actually doing pretty well, but pretty much spattered. The banks came back a little bit. You zoom out onto 180-day, and that's where oil really starts to shine here. And then again, banks not doing that well. Tech doing pretty good on the side of it. But really what starts to stand out the most, in my opinion, as you zoom out to the 1 year is the insurance and financial companies along with tech. Tech has just been exploding this year. I mean, Constellation Software, Shopify, we're going to talk about briefly, but you look at kind of the insurance companies like GWO is up 30%. Manulife's done very well this year. Even Power Corporation hiding down at the bottom here is only up a couple percent, but with the huge dividends doing pretty well. But yeah, again, we're not going to look at all of these kind of stocks, but what I really want to fixate on are the ones that have done exceptionally well, plus some earnings that I haven't highlighted this week, including some of the ones that I like to do with the real estate investment trust side of things. And I thank all of you for joining on this wonderful Sunday evening here, folks. I haven't gotten time to do a stream yet this weekend, so I appreciate you guys showing up for Sunday. What do you think of XDIV? Only 18 companies, but good quality ones. I'll take a look at that toward the end of the stream, so we'll keep that up. I appreciate you shouting out some dividend ETFs. So let's start with Dollarama first and foremost. And these are the stocks that I think have done the best, but if you start chasing them here, I think you're going to probably find they're not going to be performing as well as some other stocks because the price to earnings multiples on these have just gotten nuts. And it's really dependent on how well they can kind of, keep these earnings going. And the earnings, I have to say, have been pretty good. But from like an asset to liability standpoint, these aren't tech companies. I don't know how Dollarama has the capability of trading at a 30, above a 30 times multiple when, Google can't even kind of demand those kind of price to earnings multiples when considering their debt to liabilities is pretty much just, voiding itself out. I mean, we're not talking about like one of the most insane balance sheets on the planet. When we take a look at the revenue and sales here, just take a look at their sales. I mean, the sales growth has been really great here from 1.2 billion to 1.4. Their gross profit's been growing fairly nicely, but again, we're not talking about anything super parabolic, but in the realm of the environment we're in, it's no surprise with everybody kind of running to the dollar store to buy goods these days. Earnings growth really great here. I mean, from 67 cents to 86 cents. I can kind of see why there's a lot of intrigue in this. It looks like they've also been buying stock back as well, so that's probably been helping them out quite a little bit. So when it comes to Dollarama, if I had to give it a thumbs up on something, it's definitely like the earnings and revenue side of it, but from the balance sheet perspective, this is one of those companies where you just hope it doesn't burn out because there's nothing really backing it outside of the revenue growth, right? Which could just be a blimp in this kind of market where this just kind of happens, right? So another one that I've looked at that I think still has good potential, and this isn't one of these parabolic ones that we're getting into, but I didn't really get into Canadian apartment properties. This is kind of one of the premier Canadian REITs that exist out there, and it posted earnings, and it's one that I like to pay attention to the most because it gives the most insight, kind of like Dollarama does, I think, to like how consumers are spending. And Canadian apartment properties gives an idea into how the rental market is doing and kind of just the general broad view, because man, we're looking at such an explosion in their general occupancy along with the rising AMRs, just the kind of what people are paying for rent here. And this isn't even close. Like if you go on Canadian apartment properties website, which I should do real quick because it shows you the average like what they're charging for rent right now and how they're going to grow into these rents. So we kind of go to Canadian apartment properties. What I always find most intriguing is you can see right here, these are just some general properties that you can rent from right now on like Yonge and Eglinton apartments, some duplexes. And you can see that the average rent's pretty intense here. I mean, from like 2 bedrooms right here, from a bachelor to a 2 bedroom from Yonge and Eglinton, I mean, you're looking at anywhere from 2,000 to 3,100 a month. I mean, a bachelor, I'm presuming, is starting at around 2,000. You know how crazy that is? And right now, as mentioned, their average rental income is only around 1,500. So they're going to have a lot of time, in my opinion, to grow into these average rents. Like they're going to continue to see this go up in perpetuity. So, I mean, there's a lots of room for growth here, but what they're getting hit by is obviously the higher interest rate environment. They do have a fairly strong balance sheet, but they've been able to grow earnings. I mean, they're still able to grow earnings. Their funds from operation payout is actually, coming down over last year. Their distributions, they haven't increased over last year, currently from Q3, and they've also been buying shares back. They've reduced shares of this company, yet the stock is still trading down, fairly reasonably, in my opinion. So I think there's some good value set up in some of the REITs. This REIT specifically, I think there's just, once we come out of this higher interest rate environment, cap rate, I think, has some real potential to perform exceptionally well. Now, on the other spectrum of stocks that have done exceptionally well, that I think I'm kind of, perplexed on these ones. Like Canadian Natural Resources has been probably one of the biggest outlying stocks in Canada. The last 5 years, this thing has gone absolutely just bonkers. And even today, it's trading at a fairly favorable value if you're comparing it to like Dollarama. I mean, its PE ratio is only at 13, and it's now one of the largest companies in Canada. Whereas for a while, I mean, this company could barely catch any steam. And this is just primarily, I think it's one of the largest natural gas, companies basically in Canada at this point from like a reserve standpoint. But when you take a look at their earnings, they're slowing down with the natural gas and the oil environment. And I'm not sure why the stock's been able to keep up so well. The valuation's good on it, but on a year over year, the 9-month ending going from 9.4 billion to 5.6 billion. I mean, just it doesn't really kind of shine into my eyes that the stock should be growing at the rate that it's growing here. And if you just take a look through it, it's not like terrible by any metric. They can afford the dividend, but we're talking about like almost a 30% cut in an adjusted, fund flow. I mean, their cash flows have slowed down pretty dramatically. Like on the basic common shares down quite a bit on a 9-month. So I'm not sure what the hype is here. I mean, it's just, from the last quarter, it is up, but on a year over year, it's just not looking as great in my opinion. So I'm just perplexed to how long this stock can keep it up for. I know they keep increasing dividends, and I think that might be what's driving a lot of it. But let's talk about the utility front, because I know there's a lot of investors out there that do love their utilities. Over the oil and energy companies, utilities do have a special place in my heart. Because everybody loves these. They're very pronounced in the dividend investing community here in Canada. And these ones, again, not Parabolic. We're going to get to the Parabolic dividend stock soon, but this one is green this year. I mean, we're not talking about all-time high green. It is trading down from the 2022 peak, but on a year-to-date basis, I mean, it's not red. It's holding flat, and you're still collecting a nice 4% yield at a reasonable value. And I think Fortis has probably one of the most reasonable values of many of the utilities, which isn't a pure Canadian utility. So it might not be like a favorable comparison, considering it's got most of its exposure in the US, but they've been keeping revenue growth through this tough market environment, which is surprising. And their earnings have been doing quite well here. Like I can't really complain. The EPS is up pretty dramatically here, a variance of 13 cents, doing very, very well here all in all, which is kind of blowing my mind a little bit considering, they're a little bit more indebted. And again, this is, one of these dividend favorites. But when I compare it to like a pure Canadian utility like Hydro One, I'm always, again, confused because this one trades at quite a higher multiple. And it's been one of the more intriguing ones to watch. But again, I can't figure out how this one has done so well in comparison since its IPO to something like Fortis, but the growth rate I just don't think is there in comparison. I mean, you take a look at the revenues here, and it's actually been declining. It's just that they've been able to lower the amount of power they've been purchasing, which has been increasing their EPS, and their earnings per share look great because of the lack of power they've been purchasing. But on the 9-month end, we're not talking about any absolute parabolic growth, but maybe it's just because the dividends have been increasing at a reasonable rate. I'm not too sure what the fixation on Hydro One is, but hey, it's been growing. It's been doing well. The utility sector has actually been a place of stability this year, surprisingly. And one of you wonderful people out there kind of pointed out a company called Stantec Inc. Now, this, again, not a pure kind of Canadian company, but this one also going what I would define, if you look at a 5-year chart, is fairly parabolic. And even on a year to date, it jumped up massively on recent earnings, hitting another all-time high, up 44% this year. Not a huge dividend yield at 0.8%, but a really high PE multiple. And this one only recently really started to get off kind of on the revenue growth front. because, over its history, it really hasn't done too much. So I'm kind of impressed, but I think a lot of it has to do with the backlog. If you don't know this company, basically they're just kind of a big utility company. They do everything from like water to infrastructure building out to like parks and things like that. But they've got a massive backlog of $6.4 billion. And I think this kind of helps keep the company into the future afloat, because to have that much backlog is pretty insane, considering their gross revenue has been growing pretty dramatically here on this last quarter, hitting 1.69 billion versus 1.47 billion this time last year, and the 9-month ending growing from 4.1 to 4.8. So the numbers here are very interesting. I was very intrigued that one of you guys pointed this out. It was really fun to scroll through and just take a quick brief look at this company, and you could see kind of their Canada and US revenue, US being the vast majority, but they're seeing a lot of growth in Canada because of the the growth going on here with everything from the real estate to immigration. But infrastructure, water, building, environmental services, energy, and resources. This company is a very diversified portfolio, with the vast majority of it coming from infrastructure, which is very intriguing. So let's get into the Parabolic side, the dividend stocks most people probably don't want to talk about, and then we're going to finish up with some of the ETFs in your Q&As here. But take a look at this, because first and foremost here, did I pick up the right one? We got to talk about Constellation Software. This stock has also perplexed me quite greatly. There's two Canadian software companies that I don't know how they trade at the multiples they do. I've always kind of been trying to figure out, because we're going to talk about Constellation versus Shopify, because Constellation actually pays a dividend, which is basically, it's non-existent at this point. It's kind of like Nvidia paying a 0.18% dividend, with a 5-year growth rate just being absolutely bananas, and a stock that never seems to cease its growth. And I'm trying to figure out what burst the bubble in this kind of a company, because their growth rate, and if you've never heard of Constellation, they are a diversified software company. We're going to break down their income. Now, their revenue growth rate has been stellar at 26. It's been growing at a 20-30% clip, as does Shopify, and it's actually been holding the higher growth rates even through this kind of tougher market environment, which is actually holding up against stocks like, even Google and the likes of Meta and a lot of the companies that got hit pretty hard coming into the interest raising environment. But when we take a look at their income, I'm always a little bit intrigued by the whole balance sheet here, because someone's revving their engine outside. Because of the revenue here, like you can see that it's growing fairly nicely. Like, again, the revenue growth is pretty astounding. You got licensing growing here pretty nicely from 79 million to 84 million. Professional services, which I'd really like to look into, because professional services has been the kind of end all be all driver for this company. I mean, going from 375 to 450 million on the 9-month, hitting 1.2 billion, and along with maintenance and other reoccurring. So they've got some good thing going on with professional services and maintenance. I don't know what these are specifically in their kind of service models or their SaaS, because they're doing like subscription-based software. But when we break it down, like they're spending an arm and a leg on staff. And this kind of blows my mind, because the vast majority of their income is just going to paying staff. So, I mean, unlike many of the tech companies that laid off a huge amount of employees, like they're paying out $3.2 billion for the 9-month on staff alone, which is eating up half of their income here. I mean, it just destroys their gross profit. I mean, they ate through $5.2 billion in expenditures just from staff, hardware. I mean, and again, staff makes up pretty much the vast majority of it. So it's not like one of the more lenient tech companies I've ever seen when it comes to that aspect of their income here. And we take a look, I'm trying to find their assets minus their liabilities, because what gets really cool is the comparison on the assets versus Shopify. Can I not find that in here? It's kind of lagging out on me. Assets, where's their assets and liabilities on here? Did I not find it before, or is it at the top? It might be at the top here. Yeah, right here. When we take a look at the assets minus liabilities, what really intrigues me is you got $10 billion in assets and against total liabilities of $8 billion. So again, it's not like the most lenient balance sheet of all the tech companies out there. I mean, they're spending an absurd amount of money on staff, and they're not like, they can't pay off all their debts tomorrow fully if they kind of wanted to. They're kind of like evening themselves out, because their current liabilities set at about $5 billion, and their current total assets, they've only got $1 billion in cash and about $3 billion in total current liabilities. So it's not like they can even just pay off all their current debt immediately if they wanted to. So I'm just intrigued, because if we compare it to a company like Shopify that trades at pretty much 50 billion more, almost 40 billion more, give or take 40, 50, and has also been going parabolic this year. There's some very fun kind of synergies between these two companies. Both these companies are growing very nicely. This one got hit a little harder in the the interest raising environment period, performed exceptionally well through the pandemic, but didn't see the same kind of growth rate that Constellation saw. But when we get into the balance sheet, there are some very big differences, because with Shopify, the revenue isn't even as much, which is kind of impressive here because they only did like, 4.9 billion, and their cost of revenue significantly, in my opinion, is a lot less here. To some varying degrees, depending on what they're like when you look at the what they're spending it on, because most of it is just merchant solutions, which again isn't like staff related. So I don't know. And when you take a look at the balance sheet, I mean, they've got 10 billion in assets, again, very similar to Constellation. But when you look at their total liabilities, 1.3 billion, they have like no debt at all. But honestly, does $8 billion really make that much of a difference on the overall market cap valuation? Should it make that much of a difference that they don't have any debt liabilities? So I'm so perplexed by these two companies because they both trade at pretty wicked valuations. They're both growing nicely, but Constellation has like a wicked amount of debt on their balance sheet and comparable to Shopify. But one's actually doing more revenue than Shopify is. It just has higher expenditures. So I don't know. I always find these two companies very intriguing because they're like Canada's largest tech companies. They just trade at just wicked valuations. And, I'm not really buying them for dividends, but hey, Constellation Software is a dividend company that does grow it nicely. It's just very interesting. So let's talk about kind of rounding the conversation off into why I don't think you should be focused as much on these companies. A lot of people love Fortis and Hydro One, and, there's a lot of great companies in here, but they all trade at fairly high values. Whereas now is the time that I think instead of trying to pick up, the bank stocks, which I'm desperately waiting for their earnings to come in, I just think between banks and some energy stocks, your Enbridge out there, your telecommunication companies, they've just been absolutely slaughtered. And the vast majority of them are some of the highest weighted companies in VDY. Like all the stocks I want to buy at the end of the day, no matter how much it boils down to, it pretty much boils down to VDY. VDY, I mean, this company right now, this ETF is trading like 16% off its recent all-time highs. And if you're just purely looking for income, you're retiring. This is what I'm talking about with my parents, and you're looking for valuations that make more sense. You're getting a 5.17% starting yield paid monthly right here. You're going to lose about 0.2% of it to management fees. So you're still getting just around an average of an even 5%. But when you look at the weighted holdings right now, they're just, again, it's fairly concentrated. I wouldn't recommend buying like this as your pure ETF holding, but when Royal Bank and TD make up 25% of this ETF, they're the two best banks you could probably possibly buy. And I'd argue both of them are trading at much more favorable values than they pretty much have throughout their last decade, especially when you're looking for income at that current yield they're offering. And then you got Enbridge coming in at the third place. Canadian Natural Resources, which again is pulling back, but you're getting one of the largest natural gas powerhouse companies in Canada and pretty much in the Western world to some extent next to Enbridge. Really, like Enbridge and Canadian Natural Resources, if you think natural gas is a huge proponent to the future, then these companies are going to be the big players, right? And they're both trading at favorable values today. You got Bank of Montreal, Bank of Nova Scotia, the cheapest bank stock that exists out there, BNS with the highest dividend yield. You got Suncor. Then you start getting into some of the telecom giants like Bell, Manulife. I mean, these companies are the companies that I'd want to buy today if I was buying individual stocks. So why not just get them weighted at the best? And again, you take a look, if you want more equal weighting, I think VDY over the long term has outperformed the broader Canadian markets. I think it's starting to pull back a little bit in comparison, but just because tech companies have kept up so much. But I still think there's going to be better potential for your dollar today than in some of these, broader companies with the TSX. So you look at something like XCI, another favorite out there that is pulling back. I think off its highs, it's incomparable. It's down 17% right now. And this one is more equal weight. I think if you wanted a more equal weighted ETF, pays roughly the same expense ratios. You take a look here, the dividend yield's at 5.45%. I actually think it's higher than that because this is the 12-month trailing. I think the current distribution yield is 5.7. But again, I don't think in the long run, this one technically outperforms VDY just because VDY upperweights, the bigger Canadian stocks like TD and RY. But when you take a look at the holdings, again, fairly equal weight with Enbridge. TELUS, I absolutely love. TRP I could give or take, but you got Toronto Dominion Bank here, CNQ, Suncor, Royal Bank, BCE, Fortis, Bank of Montreal, and all of these are pretty much equally weighted, with the top four here being, weighted maybe by like 0.5% higher. But when you look at the exposure, it's fairly equal between energy and financials, with utilities, coming in at a bit higher in communications, whereas VDY is like 55-60% financials. So, I mean, it really depends on what your risk tolerance is, but even buying both of these ETFs, I think you can't go wrong. And these are the things we talk about with my parents into retirement. Like if you need income today, these things are absolute steals. You're getting the best value stocks in the Canadian market right now. And you're locking in yields we haven't seen in a decade. Now on the US side of the border, I've been seeing people kind of beat this stock up a lot. And I just the same thing with the Canadian dividend stocks. It's like the only value in the market today is in these dividend companies, and these dividend ETFs, these three dividend ETFs specifically, are doing a wonderful job at weighting what I think are the more better value plays. Because with Schwab here, if we just take a look at some of the holdings on the US side in comparable, I mean, you look at things like Broadcom, you got Verizon in here, Coca-Cola, Pepsi that have started trading down, AbbVie, I mean, Home Depot's in here, Pfizer that's just been getting wrecked. A lot of these companies that are just, trading at much better values. Some of them are getting hit on a revenue front, but these are just opportunities in a tougher market environment, right? So those are just my personal opinions. I'm not obviously advising anybody to buy these kind of things, but let's take a look now because I know some of you guys recommended some stuff. So let's just take a look here first and foremost. What do we got? TNT. Oh God, TNT. I also bought TNT on recommendations, but I'm down. TNT got wrecked. I feel real bad for a lot of the REIT holders out there. A lot of people in our chat group, thanks to the patron members, they've been talking about some of these REITs, and like I said, this is a true environment where these are the kind of stocks that get wrecked, right? True North, is a more they had more government contracts, and I think the government, with them talking about subsidizing a lot of the buildings, I'd have to look deeper into it. But man, did this REIT get wrecked? It was so stable for so long. I'm sorry, this is the OTC market ticker. Unfortunately, Google hates me, and they got rid of a lot of the Canadian REIT tickers for some reason. But if we zoom out on the max chart here and just try and take a look at this from 2013, I mean, you couldn't go wrong with a company like this. Can I just take a look at the charting? Look at this. This company blows my mind because it just shows you how quick of an environment things can just change really good companies. So, I mean, from 2013, this thing was just stellar, just paying like a huge dividend yield. I think it was upwards of like 8 to 10%. And then just because higher interest rates, all the fear in government and housing problems, this thing just got absolutely devastated because they were so focused on office, right? And especially government office. So it's such a shame. Same with like NWH. I think Northwest Health Properties here is another good example. This one just can't handle the debt load. Like they're paying so much in interest payments right now. A lot of people think this could be a good recovery play because it's kind of like MPW. It's Canada's version of MPW. When you take a look at the long history, this company goes way, way back. I mean, it's got history going back, I think, is the early 2000s. And it did very well. I kind of got hit really hard coming into 2015 for some reason, but it looked like it was stabilized, paid a huge dividend yield, and now is hitting lows it hasn't seen basically since the 2008 financial crisis. Just because of the amount of interest they're paying on their debt load, which is just crazy, right? It's just bonkers. BNS just closed down a bank near me and laid off 3%. Yeah, I mean, most of the banks did layoffs, right? Royal Bank did a layoff. Bank of Nova Scotia is closing off. Like they're trying to. I can appreciate what they're doing because they got rid of the bank in my town. And honestly, say goodbye to brick and mortar banks. That day is coming and it's fast approaching. I have friends that actually work for Bank of Nova Scotia as tellers, and they said the only reason they have tellers at banks anymore is because old people want cash, and old people still cash checks at the bank. I have no reason to go into a bank, maybe because you're getting a mortgage, but I don't even know how necessary that is to go into a bank when most of it's even done online these days. It's just submitting paperwork. So, I mean, the days of brick and mortar banks, you're going to continue to see those kind of close down, and it's going to increase margins and revenue for the banks. So, I mean, I'm not like opposed to it. I don't think it's a negative thing on the company. And again, they're laying off employees because it's a tougher market environment, even though their revenues are growing. Not Bank of Nova Scotia's, but Royal Bank, TD, they're growing revenue and they're still laying people off just because, hey, they're not making as big of EPS numbers, and that's because of loan loss provision. So they're going to do whatever they can to, make shareholders happy, which again is going to do great when they get out of this tougher market environment. And bank earnings are coming up. I'm very excited to see if they're going to continue to put crazy loan loss provisions aside, what the delinquency ratings look like, because they have been going up, quarter over quarter, not as high as the pandemic yet. By I think they have quite a ways to go before pandemic level delinquencies, but it's a true sign of the times to see how bad the markets are with housing. I own Plug and was a victim to the last week lost. Plug Power, talking about the EV stock, right? Let's take a look here. Yeah. Oh God, painful, man. This thing is getting wrecked right now. This is the real weird thing in the market. Like a lot of the, like your end phases of the world, and a lot of these kind of stocks have been getting absolutely devastated, even though they're starting to come into reasonable valuations. Their growth is slowing down a bit to some extent, but it's very intriguing to see how much people have pulled back on the renewable energy sector. So I don't know if there's value setups there, but I feel bad if you got devastated on it. I mean, there's been a lot of pain. It's a cyclical pain. It's hard to tell what's going to get hit next. That's why it's like you see, I don't know anybody that's making real money in this market. It's very tough, and they're going to be, oh, the guy that owns GICs and bonds. 5% is not real money. Come back to me, when you're making 10 or at least 20%, because 5% that's not going to last. It's not going to last. I think the real earnings are going to come from the dip buys right now. But also, let's take a look here. YTSL, amazing way to invest in Tesla for ground and get monthly dividends. So I do not like this ETF. I'm not a fan of option ETFs. I mean, there's some good ones out there that I've discussed in the past that have actually outperformed the Canadian markets, but they're mostly for Canadians specifically. They're like, US stocks, 50% of the US holdings are traded against in options, just call options. And it's done fairly well because it's been hedged against the US dollar. And that's one of the few reasons most, option ETFs in Canada have done well, but most of the Canadian ones just haven't done exceptionally well at all. But a lot of people like getting their Tesla exposure to this YTSL. Did I write that in right? Yeah, it's YTSL, right? So let's take a look at this real quick and just see how it's been doing. We'll take a look at the chart first because it's paying 57%, which is just laughable because that's not going to be consistent. When we take a look at the year to date here, it's not doing. It looks like it's flat since 2023 beginning here. It looks like the stock price hasn't changed too much. I'd love to see I think the you need some. I don't know. I don't trust this at all. I just don't trust it. I just don't know anybody. Well, the distribution yield right now is 19.2%, so it's come down pretty dramatically. You're paying a massive fee here, and I have reason to suspect that this thing at some point, is going to underperform the market. If this is just the Tesla yield, I just don't trust it, man. You can try and explain it to me, but I have a hard time believing it's gonna do exceptionally well here. What about ASML? So ASML has competitors now, eh? I was really blown away when Canon announced that they could produce chips at the, what was it, like 2 to 5 nanometer level, which is basically the level that ASML is working at. And the chip sector is just scary. It kind of reminds me of like what Warren Buffett said, right? Like this sector over a 10-year period is insanely volatile. Because sometimes once like Intel, some of the biggest companies in the space get wrecked by other companies that are innovating, and the chip sector just takes the next guy to have the better mousetrap. And it's crazy that Canon and the camera company can now produce these chips that were supposed to be so profoundly impossible to produce. So ASML is still doing very well, but I think their earnings actually dropped on the last earnings call. I think they're starting to see a bit of a slowdown on people purchasing some of the machines. TSMC is doing great. You still have the Taiwanese thing with China, which could be a concern with the company. I think TSM is probably the best play of the bunch, even though their revenue has been slowing down pretty dramatically. In fact, the only company doing super well in the chip space is NVIDIA, in my opinion. I think Broadcom's not doing bad either, I don't think, right? I don't know, but NVIDIA has probably been the best. And this was just pure happenstance because, when they were big into crypto and crypto mining was the whole thing, that's what really blew them up into 2022 until that crashed. Then the revenue fell off a cliff until all these big tech companies realized AI was the future, and they wanted these, advanced H100 chips they were producing, and they cost $30,000 to $40,000 a pop, brand new. Actually, how much are those H100s trading for today? Let's just take a quick look, shall we? Yeah, these chips, I mean, I think they have the H200s coming out now, but the H100s, yeah, I mean, they're still $40,000. So, I mean, and the only people buying these were companies like Facebook and Tesla was buying them. And that's where all the revenue came from. And I don't trust it because the day that, these big chip or these big companies are like, okay, we have enough chips for this AI revolution and we're going to work with what we got. I mean, their revenue could fall off a cliff, right? So you got to be a little careful. The chip industry, there's some good chip ETFs out there, but I don't know. Like I like TSM a lot, but you have to deal with the geopolitical stuff. Otherwise, I don't know. It's a convoluted world in the chip industry and will continue to be. I would rather own the companies that are utilizing the chips because they're the ones with the residual revenues, like your Amazons and your Teslas and your Facebooks of the world, right? They're going to see a better benefit from it because the chips are like selling. It's weird because it's like selling picks to the miners, presuming the miners might not always find gold, but it's like the miners have all the gold. And the chips, though they might be the picks to the AI revolution, there's a lot of different versions of those picks, and some of them are better than others. So it's very convoluted. So let's take a look at XDVI. I know you were shouting this one out, and I haven't taken a big look into it, but this could be a good one as well. The iShares Core Canadian Quality Dividend Index here, and actually it looks like this one has been performing better. It's only down 9%, a lot more stabilized. Actually, thanks for recommending this. This is one that I haven't looked at in a little while from BlackRock. Let's just do a comparable here. This could be a fun one, actually. Taking a look real quick. what are we talking about? So the dividend yield here a little bit lower, but that's the 12 months. So the actual distribution yield is about 5.12. So falling in line with VDY here. Let's take a look at the holdings. The expense ratio, I'm presuming, is roughly the same at about 5.2, correct? Why am I not seeing the expense ratio? I think it's down here. Yeah. So actually it's lower. It's 0.1. Oh, wow. So the expense ratio is actually a lot more reasonable with this. What are the holdings? Oh, yeah. So also very diversified. So you got Manulife here. The top holdings actually fairly bigger in comparison to something like the broader XD or whatever the XDIV is or whatever. But Manulife, Fortis, Suncor, Pembina, Sun Life, TD, Royal Bank. So I mean, this one's pretty good too. It's fairly diversified here, mostly in financials as well, a little bit of energy. So fairly similar. Not a bad one. I mean, you could really buy all three of these. These are great ETFs. And this one's actually doing exceptionally well. It's a good recommendation, actually. I'll keep that one in mind. Thoughts on WCN? This is a great stock. I've always loved WCN. Waste Connections is very nice, very expensive company. They will continue to be expensive. It's like the Canadian counterpart to Waste Management. Actually, I think it's been doing better than Waste Management. Oh, no, Waste Management came back. Waste Management's actually done very well here. But both these companies are very similar. They're kind of like, you can't go wrong because waste never changes. These companies have grown with population densities everywhere just because, you have to deal with waste. And let's just take a look at the growth rates. Actually, I want to take a quick look because these are great dividend stocks. I mean, they only pay 1%, great increases on them, but let's just take a look at the earnings because I don't think I've actually clued into these ones. Actually, can I just Waste Connections? Let's just see how these companies have been doing, just to show you how fast, the boring stocks do. Third quarter. This came out October 25th. Let's take a look here. Because revenues. Yeah, I mean, revenues increased nicely here. I mean, look at this, going from 1.8 billion to 2 billion, 2.06 on the 9 month, from 5.3 to 5.9. Like, the growth rates on these are stellar. I mean, you look at the operating income, 930 million up to like over $1 billion. Looks like this could be the first. This is great. I mean, I don't know if this is the first year they've done $1 billion. It's only 9 months, so they've done over $1 billion already before, probably. But still, I mean, just absolutely stellar growth here. What's really funny though is their diluted earnings actually don't look as good. It looks like their diluted earnings have gone down. I'd have to figure out why. Interest expense. Look at the interest expense. Actually, okay. So this company's also paying a lot in debt. Look at how much their interest expense has gone up. This is where the reality kicks in. I'm surprised the stock actually isn't down more, but 137 million to 204 million in interest. So their interest expense has gone up pretty dramatically here. Interest income, it looks like they're also making a lot more off some of their cash, but I mean, it's not doing them any good when they're paying a huge amount of it out. Either way, I love this company. This company will do well. I figured I'd hope this company would be down more. Let's take a look at their debt. Total assets, they're sitting at about 17.7 billion versus total liabilities of about 10 billion. Current liabilities 1.5. They can definitely pay the current. Well, they can almost pay off current liabilities, not with cash. It looks like they've only got 100 million in cash. And they have accounts payable of 604 million. I wish they had a bit more cash at hand there, but still, I mean, they got a lot of great stuff going on here. Cash and cash equivalents, prepaid expenses. I mean, they got 187 million in prepaid. Accounts receivable is almost $1 billion. So they got a lot of cash coming in. This great balance sheet, great company all in all. Depreciation is pretty large. So I mean, that kind of doesn't really take into consideration. So I mean, there's an extra 632 million that's just depreciation costs. This company's great. Really great recommendation. I love WCN. It trades at a wicked value. It's always going to trade a wicked value. So Smart Centers and RioCan reported looks good. Yeah, they're doing. I didn't take a look at Smart Centers. RioCan I did a video on, and RioCan's doing fine. Let's take a look at Smart Centers. I haven't looked into this one. Let's see how they're doing. Because RioCan, ever since they redid the balance sheet, they've been great coming out of the pandemic. But Smart Centers, honestly, these are more retirement stocks. I don't have an issue with them. It's just that you don't get a lot of growth. There's just better REITs out there. Where is their financials? Let's take a look here. It's kind of lagging out on me. We don't want annual. Where's quarterly? Press releases, quarterly reports. Yeah, let's take a look at the Q3 real quick for you guys. Let's see what's going on with Smart Centers. Let's take a look. Total assets 2023. It looks like their total assets continue to increase, which is nice. The debt, actually the debt's pretty reasonable here. Looks like their debt to asset ratio is 43%. That's not bad at all. Their weighted average interest rate, which I should have pointed out on Cap REIT, Canadian Apartment Properties, their weighted average is like 2-point-something%. It's really low. Whereas I noticed these retail REITs, they're paying quite a bit more, but maybe that's just retail. They're paying about 4%, which has gone up a lot over last year, 3.6%. Interest coverage ratios 2.8, it's going down. Weighted average debt. Okay, so this, again, good balance sheet. These are some of the best Canadian REITs, and their NAV value, they're all trading well below NAV. I think RioCan should still be trading around $25 a share. So you're still getting a bit of a discount here. Rental and investments. Let's just take a look at the income here. Funds from operation increased by the looks of it. Net income, not bad, actually. Adjusted funds from operation. Let's see the year over year from 81 to 85. Yeah, they're growing. Actually, it looks like Smart Centers is doing really well. I'm actually surprised at how good this is looking. Their adjusted funds from operation didn't change a whole lot, but their net income is kind of doing pretty well here. Year over year, it's still growing slightly. Like net income, there's not a lot of changes on their actual EPS, but when you take a look at their actual funds coming in here, they actually look like they have been increasing fairly nicely. It's just, I imagine they're losing some of it to debt or some other issues on God knows what, maybe write-downs. Either way, not a bad balance sheet. These two REITs are great for income. I think their payout ratio is a lot higher. Does it show payout ratio here? They're going to show me the payouts. Payout ratio is about 96%. Which again is probably not accurate because they're going to have depreciation costs. So their payout ratio is probably lower than that. Payout ratio from cash flows provided by operating activities is 87. Like they're in a great place. These companies are fairly reasonable dividend stocks. Nothing to worry about there. WC in great stock. There will always be a need. Yeah. So we just talked about that. Chad, Enbridge is fine. What are you saying? Even with the three companies they want to buy, I will make a killing. Yeah, Enbridge, I think people get too caught up in the fact they think their payout ratio goes beyond their cash. It doesn't. You got to take a look at their earnings because EPS doesn't take into consideration depreciation and amortization costs. Everyone always reams like TELUS and Enbridge are like, they can't afford the dividend. It's like, well, if you wipe out usually like the crazy amount of money they're depreciating that gets taken out of cash flow, that doesn't directly reflect cash flow, but they do. If you take a look at their earnings, it does show you their payout ratio versus, income before some of those expenses, and they can afford the dividend. They just increased it, didn't they? They didn't Enbridge just do like another dividend increase or something crazy. They're great companies. And again, Enbridge and Canadian National Resources. Enbridge is going to become, if that deal goes through, they're going to become one of the largest natural gas powerhouses in the Western world. They already are the blood veins of basically the entire Western landscape. And I think they have the largest pipelines globally. They span all the way from like Alberta down to like Texas or something crazy. I hope EVs completely fail. I don't think they will. I think we're in a tough environment. I hope they fail so I can buy into a company like Tesla. I want Tesla to crash and it just won't. But EVs, I don't know why you'd want them to fail. I think they're going to come back with a vengeance. I think right now it's going to be a bit of a hindrance for the most of the market, but it's just going to open up some buying opportunities for the long-term run, I think. What are your thoughts on Google and Amazon? I think Google and Amazon are probably the two best buying opportunities of the S&P top 10 right now. I've talked about this relentlessly. Like, look at Amazon's revenue growth. Amazon, arguably, I've never really been for Amazon because I never understood their business model because they never showed earnings, but now they're starting to show a bit of earnings. But look at the revenue growth. This company's still growing. Their last earnings was up higher than this. They're not reflected here for Q3, but they're up way higher than this. Google, Amazon is just going to be a powerhouse for the foreseeable future. It's a true sign that e-commerce hasn't slowed down. Shopify's earnings are another good example of this, right? Like, we're still in an e-commerce revolution. E-commerce is still scaling at a level even this tough market environment can't stop. It slowed it down, but there's still huge potential. And Google, do you believe, like, of all the streaming services, I think Google's the premier. They're billion-dollar brands like Mr. Beast growing out of Google right now, and Google doesn't have to pay for content. And I think Google's just got to diversify out of YouTube, and I hope self-driving takes off for them at some point. Lots of potential with both those. They're my two favorite companies on the S&P top 10 right now. I like Meta, but Google trades at a better valuation today. And I don't know, they're just friggin' powerhouses. But again, you could just buy the S&P 500, or if you like the QQQ ETF, that way you get all those companies and you can just cost average into the Qs. They're just not going to get hit by this environment as much as some of these other stocks are. Give me a shout out, long time fan support. Vic Gill's been OG here. I appreciate you always stopping in for the stream, especially on a Sunday night, man. We all got to get geared up and go back to work tomorrow. I feel depressed. Too much work. I'm starting too many projects. I got to do some patron member posts. I've been backdated on my Patreon. I appreciate the patrons because so many of them stay subscribed. So I hope a lot of them are in the chat group and shooting the shit once in a while. But there's so much patron content I want to get caught up on. Santa rally shopping. Yeah, it would be neat to see what the can Apple turn around the iPhone sales going into the holidays? I don't know, maybe that'll be neat to see. Own both RioCan Smart Centers. Glad they're doing okay. Yeah, from a balance sheet perspective, the stock prices are suppressed, but the balance sheets, they're doing fine from a balance sheet. I also believe Hydro One owns most of the power lines in Canada. Great company. It owns, I think most of them. I think it's an Ontario specific company. I don't know how much spread. I think they're purely in Ontario, and maybe some of. I don't know if they go out to Nova Scotia or something, but they own a lot of the hydro lines for like I think a couple million or a few million people. It's not as crazy as you think it'd be, but it's definitely like a huge proponent to like the Toronto economy. But what do you think of big tech stocks? What will they do next year? I think utility banks, REITs will be the big players next year. SHD, BDY look great. VFV, XQQQ. Yeah, XQQQ gives you the Qs, right? I can't see much more upside this year. So with tech, you have to always expect the unexpected. I know a lot of people think tech's overvalued, and I think a lot of it is. But the problem is when you look at the Qs, most of these companies now are growing back to where they were post like crash period. That's what I don't think people understand, right? I think they're very expensive. It's hard to wrap your head around companies like Constellation Software and Shopify, but when you look at a company like Amazon and Google, they deserve to trade at a premium. Tesla, I think, is expensive, but does it deserve the premium? It depends on how much you believe in robotics. Apple is slowing revenue growth, but they're still keeping their EPS up nicely. Microsoft's growth is coming back. I mean, let me just pull it up to show you how insane Microsoft investor. I don't think people appreciate the growth here, though. That's the thing, right? It's just everyone says they're expensive, they're expensive, they're expensive. It's like, yeah, but do they deserve to be expensive? That's the thing you got to wrap your head around. Where was the last earnings report? This is not what I'm looking for here. Q3. We want 2023 Q3. Can I find this here? Let's pull this up real quick. Look at this. Just where's the numbers here? So when you take a look at revenue, the revenue increased 7%, which is up 10% on a constant currency basis. Operating income was up 10%. Net income was 9%, 14% because of currency. And diluted EPS was up 10%. I mean, we're still talking about double-digit growth here, right? This isn't as astounding as I think like Meta. Meta was in the like 20% range. I think Google came back a lot. I mean, there's some like these growth rates are really nice for companies at this size. I mean, you're talking about 10% revenue growth or just in general, like net income and stuff on the money these kind of companies are making. Like it's jaw dropping almost, right? So if they stay in double digits, I understand, the Qs and these companies trading at a 20 to 30 times multiple. They just got to get back up to the 10 to 20% rate. But again, you don't know, right? Magic Man, SCHG over VOO. What is SCHG? That's another one, SCHG. So this is the Schwab US large cap. Let's take a look in comparable. It looks like it's falling in line. Why year to date? Oh my God. Yeah, it's coming back with the Qs, right? This looks like a great ETF. I don't know if there's comparables. I honestly like owning. I'm going to start buying the Qs and just cost averaging into them. I don't think there's a comparable difference in like, yeah, they're overvalued, but what are you going to do? Not own tech? I think it'd be crazy not to own tech for the next 30 or 40 years. If you got that long of a time horizon, even the next 20 years, I think tech's going to still be the proponent of most of the future growth. But in the macro, I mean, you can't deny that dividend stocks are where the value's at. I mean, as soon as they cut rates, come back to this video, and I'm going to state it over and over and over again. It's the only bet that I have that I'm really assured of is that when you look at companies that are getting largely hindered by debt payments that are still growing revenue, like TELUS, like the banks, I mean, those companies, as soon as the economy stabilizes and they start cutting rates, and those companies, they will never come back to it's like when Meta dropped down to 90. I mean, we're talking about decade level, value. It's going to turn back around at some point. So you kind of just have to own the whole market, right? That's the problem. It's just like in markets like this, maybe slow down on buying growth. Yeah, the Qs had their value. Tech had its value, and most people didn't want to buy it. I mean, I didn't buy it as much as I probably should have, for sure. I missed out on that, right? But now I'm like proponently just buying these ETFs because I think there's more value in VDY and SCHD. But that's not going to stop me from still buying tech companies. I mean, I'll start buying here fairly soon. But I'll pass the question off to you guys. I appreciate y'all hopping in and having a great conversation. I'll answer this one more. Yeah, I mean, you guys kind of can figure this out from here. I appreciate y'all stopping in on a Sunday evening. A wonderful live stream as always, folks. It's been a nice 43-minute ramble about stocks. So I'm glad you all like nerding out. Nothing like nerding out on a Sunday before Monday markets hit. And honestly, I'm expecting more of a bull run. I mean, I was looking at, we can finish up with just taking a look at the broader markets. Crypto is exploding right now. I'm kind of blown away by how much speculation is coming back in the market. I mean, you think tech stocks are expensive? I mean, you look at the lower end tech companies and they're getting really expensive again. Like Palantir's value is starting to get back up there. you're looking at a lot of these really hype kind of growth companies, and crypto should be a great example. I mean, Bitcoin's back up to what now? I think it's up to 37K or something. And then you look at like all these cryptos trading over the weekend. I mean, there's so much crypto value. Look at this. Sorry, I was not showing the screen here, but you look at all the crypto values, like Matic's up 12%. There's cryptos that are up 177%. So, I mean, there's like crazy, crazy stuff going on in the speculative market again. So, I mean, there wouldn't be surprised if we see some more green tomorrow across the board, but stay cool, stay awesome, folks. And as always, I look forward to catching you in the next one. Peace.